Welcome to the Business of Soil Health. I'm Patrick Smith, the founder of Soil Upside.
And I'm Sammy Telleton, the co-founder of FarmRaise. I'm thrilled today to welcome Lauren Manning to the Business of Soil Health podcast. Lauren is the executive director at Food System 6, and her experience ranges from ranching to law to venture capital investing. This is going to be a very rich conversation. Welcome, Lauren.
Thank you so much. Thanks for having me.
Of course. So you have had a very rich, very dynamic journey across the food system. How have your experiences converged to shape your focus on regenerative agriculture in particular?
Thank you, Sammy. That's a great place to start. And I appreciate the framing of rich and dynamic because I think my parents are still scratching their heads going, what's the thread here? Or where does this all go? So rich and dynamic is a wonderful way to think about it. All the different background experiences I've had have really just given me different lenses and different hats to wear. And the one that I value most is my experience as a grass-fed beef producer in a deeply conventional area in Northwest Arkansas, where we truly were the outliers in doing what we were doing. And when I was in venture capital, it's when I also started farming. And it was just really interesting to be looking at so many technologies and trying to connect the dots on, are these really offering value for producers? Would they buy these? How would they use them? Why would they use them? Why wouldn't they use them? So having experience as a producer was just absolutely invaluable in looking at technologies and understanding which had the most opportunity and appeal for specifically livestock production. My experience as an attorney, that's always helpful when it comes to understanding different perspectives, understanding how much of our regulatory system affects what we do in agriculture and why we do it. At Food System 6, we're starting to take a really deep look at the federal farm safety net programs, which requires a lot of digging through the Farm Bill. So I'm just grateful to have that background and be able to understand some of that legalese, or understand when I don't understand the legalese and need to talk to someone who's more of an expert in that situation. So I think it's really helped me not take such an academic approach to everything that we do. And I understand the need for academics. I don't want to speak negatively about it at all. Academic research is critically important to the food system. But when it comes to innovation and how do we change what's happening, having that on the ground sense of what's it like to be a producer, it's really critical. And especially now in our work on innovative finance, I was a first-time farm buyer. I was a first-time operating loan borrower. So I was interacting with Farm Credit and FSA on a weekly basis at various points through my farming career. And there's so much I could say about that experience and what it was like. But it just really was eye-opening in terms of, if you're a producer who wants to do something unconventional, the way that your loan officer perceives you is often what determines whether or not you're going to get the financing to do what you want to do on your operation.
How has your experience as a producer and, as an attorney and a VC investor, how has that informed what you're doing at Food System 6 and the priorities there?
Yeah, so there's an anecdote I like to share about when I went to get my first farm loan. And I was raising grass-fed beef and lamb on leased acres, and I had apprenticed with some wonderful producers who were letting me start building out my own sheep herd, goat herd, cattle herd on their land. And I had receipts showing the prices of what we were getting, where we were selling, the volume that we were selling. I had all of this information showing that we had a really big demand for goat meat, of all things. And I found a property that actually would have been quite great for goats. It was very browsy, shrubby, lots of trees, rough wooded hillsides, which are things that goats really love to eat and exist in. And I took all this data, this information about my prices, my opportunity to Farm Credit, to FSA, and they said, that is so wonderful. We're so happy for you, but we're required to only give you commodity prices when we run your cash flow analysis. That was quite a delta between what the commodity price was and what I was actually getting from consumers. And more importantly to me at the time, again, having that lawyer brain of, if I have evidence to prove something, I should get to prove something. They really didn't care what I could show them. And I just want to say as a caveat, this was my experience in my specific Farm Credit office and my specific FSA office. I hear from folks all the time that there's lenders in these conventional lending institutions that are much more open-minded. They want to research new markets and understand. But for me personally, The fact that I was only given commodity prices means they denied my loan. They wouldn't let me buy the piece of property I wanted to buy. What they would have financed for me and what they did try and talk to me about was conventional broiler houses for poultry processing. And they said, we can put you in touch with an integrator, you can get a contract. And mind you, this would have been for above $1 million to build some broiler grow out houses. And it was just knocked me off my feet in the sense of, if you're someone who doesn't really understand the system or you feel a power imbalance, you could fairly easily get talked into a loan for something that you really had no intention of growing or experience growing. So that's an anecdote I often like to share to people about what it's like being a producer trying to access financing. And that's why at FS6, we're so keen on working with these innovative lenders who are offering loans and credit to producers who are in those unconventional markets. And these lenders will actually sit down and look at your receipts. They'll look at your market opportunity, and they're willing to be what I call a capital partner, not just a capital provider. Yes. So this would be folks that are doing non-bank lending. So they have their own loan fund and they're raising money from LPs and they're doing lending in a non-banking, non-regulated type way.
Before we dig into the weeds on what you're doing with them, can you give us sort of a broad scope on what Food System 6 is doing? Maybe starting with, what does the name mean? And then what are kind of the highest priorities?
Yeah, that's such a fun question. And we spell it all out on our website, but it's always fun to walk folks through it. We really look at the 6 phases of the food system. And right now we're in the 5th phase of the food system, which is industrialization. And we're seeing a lot of the negative outcomes and consequences of having industrialized and made efficiency the paradigm in all of our food production. And the 6th food system is essentially what we're trying to build. What's the phase that comes after industrialization? What does it look like? What does it not look like? And for us, our specific lens of that is the finance piece. How does the way we finance and move capital around the food system define what people grow, why they grow it, how they're growing it, where they sell it? So that's the backstory on the name Food System 6. And what we're looking at in this new chapter is access to capital. And in the first iteration of Food System 6, many folks know it as a business accelerator that helps champion a lot of businesses. But what the original founders quickly found out is that these businesses were being accelerated out into a capital system that didn't quite have money available for them, or they weren't quite a fit for some of the conventional financing opportunities. So even though these businesses were receiving TA and coming out in better shape, there wasn't a clear pathway for them to access their first loan or take on their first equity investor or really have the kind of capital, flexible, patient, mission-driven capital that a lot of these food system businesses require. So our shift now is really looking at access to capital. And there's 2 pieces of work that we're specifically interested in. The first is the federal farm safety net programs. And this is a bit of a hot take I think I have compared to other folks. Everyone likes to say regenerative agriculture is more profitable than conventional agriculture. And I can't help but think, as long as conventional agriculture has access to multi-billion-dollar taxpayer-funded credit enhancements through the federal farm safety net program, is it truly more profitable? We can get into the discussion about, is it riskier? Is it not riskier? Why do lenders have such a perception of risk around unconventional commodities and unconventional borrowers? But for us, that federal farm safety net piece is huge. That's billions of dollars of taxpayer, like my paycheck, your paycheck, Sammy's paycheck, that all goes to de-risking the type of agriculture that we're all actively working to try and make better or improve for the next generation. So in the federal farm safety net, there are so many different programs. The one that we're starting with is loan guarantees. The FSA offers government-backed loan guarantees up to 95% for banking entities making loans to farmers, ranchers, and the FSA does direct lending beyond the farm gate in some cases, but it's mostly on-farm lending. The B&I program through rural development, that's where you see a lot of loan guarantees go to things that are post-farm gate, processing infrastructure, rural infrastructure. But those loan guarantees are really powerful. They can de-risk a lending transaction. They can incentivize a lender to make a loan. And what really stood out to us is that these non-bank entities I mentioned, these borrowers emerging, doing innovative lending, capital partnership, relationship-based lending, they're legally precluded from accessing those FSA loan guarantees. And we saw that as a pretty profound structural disadvantage between conventional ag lenders and this emerging class of innovative lenders. So that first piece of work for us and reimagining the safety net is what would loan guarantees look like if we made them for not bank lenders, if we made them for regenerative borrowers. The second piece of work we're looking at is really a response to some of the current economic conditions facing producers today. And this applies to not just the regenerative unconventional producers, but really anybody in agriculture right now. Due to a confluence of factors, high input prices, tariffs, it's just a really, really tough time to be even a commodity grower. And we're seeing some pretty startling statistics about foreclosure rates increasing and bankruptcy rates increasing. And for us, it's to some people, it may seem like it has no relevancy to the regenerative movement, but what we really, truly, strongly believe and are trying to spread the message on is if we lose hundreds, thousands of acres of farmland, we don't get a chance to regenerate that land again. It's typically not another producer who's regeneratively minded who's going to buy that land. It's going to be a developer, a large farming interest that's more focused on shareholder value extraction or some other enterprise. It's typically not going to stay in agriculture. So we're doing a lot of thinking right now, outreach, communication with other folks in the space saying, what are you seeing? How big is this crisis for you? What do you feel is the most appropriate response? Where are there gaps in support for producers? And then more importantly, we're starting to think, how can we use this financial moment of crisis to engage with producers who are probably pretty sick and tired of being on that conventional commodity treadmill and not knowing whether they're going to be able to pay their lender back?
So you've talked about the loan guarantee fund. You've talked about your interest in the farm foreclosure crisis. You alluded a little bit ago to some of the work with the Farm Bill. And you also have another initiative, I think, focused on EQIP Bridge Loans. Is that right? Is there anything else we're missing?
Yeah, thank you for mentioning EQIP Bridge Loans. This is a program that we are so excited about. When I was a grass-fed beef producer, I had a $40,000 EQIP contract. And just for folks listening who might not know what EQIP is, it's a fabulous program run through USDA's NRCS office that pays a cost share for adopting certain conservation practices. So you install some of these practices and the USDA helps pay for the cost of installing them, which is fabulous. For some producers, however, especially if you get a high dollar EQIP contract, cash flowing the upfront cost of installing those practices can be extremely difficult. To be totally candid with y'all, a lot of my EQIP went on a credit card, went on a high interest rate credit card just to try and buy things like fencing materials or putting in water systems. These are big ticket items in some cases, or subsidized with off-farm income. So the EQIP Bridge Loan Program is meant to provide producers who already have an EQIP contract with the cash they need to buy the inputs they need, the materials, even cover some cost of labor if that's factored into their EQIP, and help them get that contract done faster without disrupting their existing cash flow or requiring them to put things on a credit card, borrow from friends and family, maybe not take a vacation or pay for healthcare. So we have $100,000 deployed already in bridge loans. We've got another $600,000 that we're trying to get out the door, and we're really pushing this program hard right now, especially with some of the federal uncertainty. We felt fairly strong about EQIP. We've been monitoring the situation. We see so far that it's a really well-loved program on both sides of the aisle, and we don't anticipate significant cuts or the program going away anytime soon. But all to say, if folks do have an EQIP contract, we want to help them get it done and get paid on it so that they don't have to get caught up in some kind of administrative pause or timeout or changes to the program.
That's a significant effort to get all of these farms funded, get those resources out to them. You said you have about 600,000 remaining that you're hoping to get out. Okay. So
that's correct.
What are the barriers there? Is it farmer recruitment, outreach? Is it being in the right room? How do you think about that? What barriers do you have?
Yeah, I love this question. And it's something that we're starting to reach out to other partners on and other folks in the space who have been doing direct to producer programs for a while now. It's easy to get folks to fill out our intake form. It's fairly easy to get them on a quick 30-minute call just to say, tell us about your EQIP, help us understand what you're doing, how far are you in the process, how would a bridge loan help you get things done faster. The super interesting thing, and I'm guilty of this too when I was a producer, is we eventually send them a very simple spreadsheet that asks for very high-level information about their financials, about farm income, farm liquidity, where would you get the extra cash to pay for the balance of the cost share reimbursement. And our sense so far is that a lot of producers simply don't maintain that information. And they may be commingling that funding with their personal assets. Maybe they just have one checking account where their off-farm job direct deposits into it, but then they pay farm expenses out of it. So they either just don't really know how to extrapolate those numbers, or it would take them quite a bit of time to sit down and really untether things from all their various bank accounts. And I mean, when I was a grass-fed beef producer, my financials were probably in a very similar rough shape of just kind of half filled out spreadsheets that I updated maybe during winter when I was spending more time indoors. But it's highlighted for us a need to work on more financial literacy with producers. And the word financial literacy, I think, falls a bit short from the opportunity. And we like to think about it more as financial empowerment. And this really feeds into the work we're doing with our finance innovation, the loan guarantees. A lot of producers feel a power imbalance when they speak with their lender. They often feel like they're term takers instead of term negotiators. And particularly as we see the farm foreclosure crisis increasing, what comes to mind for me, again, wearing that lawyer hat, do these borrowers know what their rights are? Do they know when a lender can call a default? Do they know what happens after that default? Do they know what's even fair during a bankruptcy proceeding? And it's stuff that we shouldn't expect farmers and ranchers to know off the top of their head because they already know a hell of a lot about farming and ranching and running their businesses. But as we see more folks come under fire, maybe feeling some financial precarity, how can we better support producers when it comes to their financial literacy and their ability to advocate for themselves? How can we show them that keeping financial records doesn't have to be super complicated, that just tracking a certain set of numbers or thinking about what numbers might be helpful for them to track could be a great way just to keep a finger on the pulse of what's happening financially in their operation? So again, to tie it back to EQIP, a lot of folks see this very simple spreadsheet, and we even say in the spreadsheet, give us numbers to the best of your recollection and ability. That we're not the IRS. We're not going to come to your house and ask you for the receipts on these. We just need a general picture of what's going on. That's when a lot of folks just say, I don't have that, or they just kind of disappear. And huge shout out to our program manager, Alex Cherry, who runs this program day to day, who really tries to reach out again and again and say, we will do a call with you. We'll sit down with you and help you fill it out. Just please, we want to give you money. Just anything you can give us is helpful. And, it raises the question of, is it better served as a recoverable grant where you just they show you their EQIP, you give them money, you hope it comes back? And that's a question that we ask ourselves fairly often, but there is also some utility to having folks go through a light underwriting process because it can help them start to develop this financial lexicon, this acumen. What spreadsheet should I have ready? What's a lender going to ask me? And our underwriting process is very, very light. It's not in depth at all. So it's a very easy way for them to start dipping a toe in the water of, if I do work with a lender and I want to be more of an active advocate for myself in this process, how can I start learning this terminology? What is underwriting? What numbers should I be prepared to show?
That's huge, Lauren. And the whole time you've been sharing this, my brain has been lighting up because prior to my current role at Kalimo, I founded Farm Raise, and we had the exact same arc where our initial goal was facilitating farmer applications to USDA programs like EQIP. But then we quickly realized that there was a larger challenge, which was helping farmers be funding ready in the first place and have the right systems of record and organization to be able to take advantage of these programs. And so I love to hear that you're focused on this. I think it's hugely impactful. And one of the things you're highlighting, the sixth food system, that focus on changing and innovating finance to be more supportive. I think in doing this funding enablement or farmer funding
Financial
empowerment work.
Empowerment, yep.
Yes. Is that you are actually healing the relationship of these farmers who have often had their financial information sometimes used against them to deny loans, for example, like your experience. You're healing that by creating this method of relating positively to an opportunity to receive funding. So do you see that coming up where there's also, in addition to just the numbers and getting everything ready, there's also a process of healing or repairing a farmer's perception of farm finance?
I love that component. And I think we couldn't think about this work without including some kind of opportunity for catharsis. for people to really express how they feel the lending system has been mystified for them, or they don't feel like they had a fair shake, or they don't really know where to go for more information. And with this body of work and this foreclosure response work, financial empowerment, how do we make producers feel like they actually have control over the conversation when they're seeking financing? We call that program Dignity in Farming is Dignity in Finance, DF2. And for us, it really is a lot about dignity. I mean, the people who are feeding us feel that they don't have a say sometimes in what loan terms they get. And to me, that just doesn't sit right.
So you mentioned, Lauren, that you have this 100K, you have a 700K allocation. It sounds like 100K, which is out the door, and that the 600K, you've experienced some challenges getting spreadsheet responses from producers. And I have to wonder if this goes back a little bit to what Sammy was just talking about around skepticism of sharing data. It's not necessarily that they don't have, maybe some of them don't have the data, but also there's, I think, an understandable skepticism to share data like that with outside parties.
Absolutely. Yes, that's definitely something that I saw as a venture capital investor when I was looking at a lot of data management platforms. Producers said, you want me to put in every single iota of data about my operation? Well, who can see that? Who can look at it? What do you do with it? Who do you sell it to? And we're very clear with our borrowers. We're not in the business of selling your data. We're not in the business of sharing it. There is some data we'd like to track in our program from an impact analysis standpoint. For example, we'd love to have credit scores and show that a credit score is not always indicative of someone's ability and willingness to repay a loan, and that just straight credit score lending can be pretty devastating for a pretty broad group of the food system. Folks who are beginning farmers, maybe they've not ever even had a car loan or mortgage. They don't exactly have a credit score. That's not reflective of whether they're going to be a good borrower or not. So there is data we want to collect for the purpose of showing that the program is dispelling certain mysteries about credit scores. We also want to collect data from our program on repayment. We really would like to show NRCS that if you give producers more money up front, they're not going to go buy a boat. They're actually going to do their EQIP contract, and they're going to be very happy to have the liquidity to get it all done sooner rather than later. So yes, we are collecting data. We're certainly not sharing anyone's personal information. And if someone wants to opt out from that data sharing, we are totally respectful of that and understand that people have different reasons for participating or not participating. I'll just say, yes, the data piece and the sensitivity around that, we are aware of it going into the program and keeping an eye on it as we go also.
But regardless, you have a lot of money to get
we
out
have a
the door.
ton of money to get out the door. Yes, we are actively trying to give away as much money as possible. And we feel so fortunate to be working on a federal program that has been so far insulated from some of the chaos, program cuts. And it just has really empowered us and motivated us to get as many EQIPs done as possible, recycle that money back into the fund, and then have a ton more money to give back out. It's an evergreen fund. So as EQIP Bridge Loans come back into the fund, we want to kick that money immediately right back out the door to the next producer who's trying to get their EQIP done, but has some cash flow problems in doing that.
Could you, switching now to the loan guarantee fund that you had mentioned before, I was curious to get a specific example, if you're able to share, of this mechanism at work. And what I'm curious about is, who are those non-bank lenders? Are there any examples that you can share there? And then who's the beneficiary and how are they putting that to work?
Yeah, it's a great question, Sammy. I've been talking about guarantees a lot lately. It's been a fun subject. And just to start, for folks listening who maybe aren't familiar with loan guarantees, it's at its core essentially a promise to pay if the borrower doesn't pay. It can be for a certain percentage of the loan or for the entire loan. So it's just helpful, I think, for folks to have that touch point of what even is this loan guarantee. It's the same as if, you're trying to lease an apartment straight out of college and the apartment manager doesn't quite like your background financially. They might have your parent co-sign or something like that. It's just a way to enhance the borrower, how they look, and make it easier for the transaction to go forward. So our loan guarantees for non-bank lenders, one of the most obvious examples of who we're trying to serve with this program is Pot Liquor Capital, a very BIPOC-focused lender. And Mark, honestly, shout out Mark, because he was the first one that got me interested in loan guarantees, I think 2 or 3 years ago now at this point. And I worked with Zach Ducheneau, and he was at FSA still. And we really tried to think about how can we carve out a pilot, a sandbox, some way for USDA to experiment, giving these loan guarantees to these innovative lenders serving unconventional borrowers. The administration changed, and we said, we've got so much work invested in this now. We see these guarantees as being so important. The innovative lenders like Potlicker are still saying, yes, we want these for a variety of reasons. So that's why we launched Guarantees for Regenerative Agriculture, our privately funded program that's really meant to demonstrate the power of a loan guarantee. And some common reasons that you see folks need a guarantee are ubiquitous throughout regenerative agriculture. Maybe, as I mentioned before, first generation producer, maybe they only have 2 years production history. There's not a lot of financial data to look back upon, but they have an exciting market opportunity. They have an exciting expansion opportunity. That loan guarantee can come in, and our loan guarantees can be as little as 20%. And a lot of the innovative lenders have said to us, we don't necessarily need the entire 95% guarantee that we get from the USDA. So things like short production history, not having enough loan to value, not having enough collateral, maybe not having enough down payment. And honestly, the down payment can be a huge barrier for folks because not a lot of people have huge amounts of cash just sitting around to go into a land transaction. So we're also leaving a lot of room for curiosity. How do these innovative lenders who already do very different types of lending and underwriting, how would they use a guarantee? Where do they call a credit deficiency, and how could a guarantee come in and neutralize that? So we are leaving some room for innovation, curiosity, and really letting the lenders who are the experts in this unconventional underwriting help us understand where the guarantee would be helpful. And the ultimate beneficiary is the borrower. So we provide a guarantee directly to the lender that allows that lender to say yes to that transaction. And the third-party beneficiary of that guarantee agreement would be the farmer rancher value chain business. A couple other pieces of the program that I'm super excited about, in addition to helping get more mission-friendly lending out the door, is the data and insights we're going to capture about this unconventional underwriting. When we aren't just looking at credit scores, yield history, some of that existing benchmark data that USDA maintains around average prices, when we're not just solely relying on that, what else comes into the fold? What questions do these lenders ask their borrowers? How do they structure their loans differently? When they consider doing a loan modification, what leads them through that analysis? When do they say yes to a modification? And then how do they modify the loan? We really want to capture what they're doing and create a new playbook for these conventional ag lenders who might be a little bit regen curious. Maybe they've had some folks like me walk in their office and say, I'm doing grass-fed beef, or I have this diversified market garden, I'm selling to restaurants, and then give them some kind of playbook where they can say, oh, here's how somebody else underwrote this, or here's what the loan structure looks like, or here's, more importantly for some of these conventional lenders, here's what the historical loan portfolio performance actually looks like. Here's how many write-offs they had. Here's how many defaults there were. So that piece, the data, the insights into how you underwrite unconventional borrowers, we see being equally valuable to the guarantees. And then long-term, the vision for the program, how do we convince FSA that the sky won't fall if they open up their loan guarantees to some of these non-bank entities? And we're excited to have several years of data when it comes time for that conversation to say, here's what it actually looked like making guarantees to them. Here's the type of guarantee they needed, the percent they used. Here's how often they called on the guarantee. Here's what their loan portfolio performance looks like. Here's the borrowers they're serving. And through all of this data and all of this, what I really consider cultural change, not necessarily financial innovation, I really view more of our work around changing the culture of money, not necessarily changing money itself. We really want to give these conventional lenders in USDA some capitalistic FOMO, is what folks often hear me call it, where like this is a great space to be deploying loan capital in, and you could also be diversifying your loan portfolios. For ag lenders who are heavily deployed in soybeans right now with the tariffs and with sales opportunities overseas diminishing, high input prices, skyrocketing foreclosures, it could be a good time to engage with them around, hey, maybe some different borrowers in your portfolio would be beneficial in the future.
I love that phrase, capitalist FOMO. So let's just talk about some of the basic mechanics here.
Sure.
You're guaranteeing specific loans, or you're guaranteeing lenders' funds? Like
Great
the
question.
entire credit fund?
Yeah, we spend a lot of time looking at that because, guarantees can take a lot of different flavors, shapes, and sizes. So one of the first things we had to get clear on is what is our guarantee product compared to other guarantee products. So we offer two types of guarantees. The one is just a very traditional guarantee for an individual loan transaction where a lender is actively in underwriting. There's a little bit of a credit gap or some reason that they're hesitant to say yes. And they can come to us and say a 22%, 40%, 60% guarantee would help me get this across the finish line. And that's when we start engaging in our own underwriting. Okay, send us everything you've got. Let us look at it. Let us understand this opportunity. And we go from there. We imagine those individual guarantees will be for larger ticket size loans, more complex loans, things like infrastructure. We would love to put 50% of our guarantee capacity in infrastructure deals to really help get investors off the sidelines and stop viewing these as so risky. And yes, they are more messy. There's more complexity. There's more moving parts, but there still is so much opportunity and need around having more infrastructure throughout the supply chain, not even just necessarily for regenerative producers, even small scale beef producers, small scale meat producers. More infrastructure would be good for everyone. The second type of guarantee we offer is really intended to be about efficiency. It is a portfolio facility guarantee where we pre-agree with the lender on the types of borrowers that are eligible, the types of credit deficiencies the guarantee can be applied towards, and we give them a certain pool of guarantee capacity. This is what we're doing with Pot Liquor. We're extending a $300,000 portfolio facility to them so that they can just keep moving loans in and out of that facility. Again, we agree what loans are eligible, what the terms look like. In Pot Liquor's case, it's a 20% guarantee that's available for every loan that goes into the pool. And that way, we're not having to go through the same due diligence and underwriting process every single time that lender sees an opportunity for a guarantee to be helpful. For some producers, time really is of the essence when they're seeking financing and trying to make decisions about what their next planting year looks like, whether they can take on that new market opportunity. So we really want to respect the fact that we don't want to be the reason we're holding up a lending transaction. So in that portfolio facility example, it really is about relationship building between us as the guarantor and the lender. So that's really about us understanding what is your mission as a lender? How do you do lending? What does your underwriting look like? And again, part of it is we want the data and insight into that. But we also really just want to understand the relationship we're building and what kind of mission we'd be supporting with these guarantees.
Yeah, the portfolio facility, I'm assuming it has a similar effect to the FSA guarantees in that it helps the lenders lower their cost of capital.
It certainly can. And we've heard from some innovative lenders that they honestly would see the guarantee as a fabulous way to raise more capital into their loan funds because they could tell their investors a certain percent of that money would be de-risked and protected. So again, the guarantee has so many different applications and appeals to different stakeholders.
What kinds of returns are you anticipating or seeing for that guarantee pool?
Great question. So with a loan guarantee, this is really essentially a grant program. It's not a PRI program. It's not an investment. We're not taking money in from guarantors. The way that we accept a guarantor commitment is through an unfunded pledge. And this is a fabulous way for folks with endowments, with corpuses at places like a DAF facility or a family office or a foundation. It's a way that they can leverage those endowment assets without actually moving them out of the endowment. So with an unfunded pledge, we would say to a guarantor, make $1 million guarantor commitment, keep that $1 million. All we need to see is that it's in a segregated account, really just so we can verify that it's there. And we ask the same of every guarantor. We feel it's important. Each guarantor knows the other guarantors are good for it and they're liquid. Keep that money in that segregated account. Keep it invested. Keep earning interest. Take the interest out of that account. That is your money to play around with and invest. You just have to keep your minimum commitment in that segregated account. When it comes time to pay their small prorated share of a guarantee call, they can pay it out of whatever grant funds they want to pay it. And it comes through FS6 as a 501c3 charitable tax deductible gift. So it's a way for them to do granting in what we see as a reactive way. Instead of just proactively granting out, it's a way to use their grant funds to really surgically meet producers in the exact moment they really need that philanthropic capital. And it would be meaningful to make the lender whole, to maybe help that borrower not lose a piece of collateral and really precisely come into the conversation when it's most needed.
I think we could spend one podcast episode or more on each of the things that you're building, Lauren, because there's just so much to see and parse out. It's super interesting. I don't want to forget to talk about the farm foreclosure crisis and what's happening there. And so how do you see these two programs, the EQIP Bridge Loan and the Loan Guarantee Program, helping to mitigate the crisis, or are there other mechanisms that you're looking for this?
Yeah, thank you, Sammy. There's a lot we're looking at right now. And honestly, it's pretty sad. It's dark most days to get the news alerts about foreclosure crises around the country, and how farmers are quite literally crying out for help, saying, like, if people don't help us, we're all going to lose our farms. And the first piece of inspiration for how do we meet this farm foreclosure moment has really come from the EQIP Bridge Loan project. I shared a little bit earlier about how a lot of borrowers who come through the EQIP Bridge Loan pipeline, they have a really hard time providing financial information, or they don't quite understand what underwriting is. They're not sure why we're asking for certain things. And that's an issue all on its own that we're looking at. How do we increase producers' ability to fill out financial spreadsheets, look at their finances, and understand what's happening? But what it sparked for us at a broader level in this moment is this question around, if I'm a producer who's facing foreclosure with my lender, do I have the skills and information I need to advocate for myself? Do I know what my rights are? Do I understand my finances the same way the lender does? Am I able to answer the questions the lender's going to ask me when that lender's considering foreclosing on my property or not? And it's really sparked for us this question of, well, what financial TA already exists? If I'm a producer facing default, where can I go? Who can help me? Who's going to help me advocate for myself? So right now, we're just in the very early stages of assessing what financial TA exists, who's out there, who's working on it. And at the same time we're doing that, we're starting to build a list of resources that we can give to the producers in our EQIP Bridge Loan pipeline and say, hey, if you really want to brush up on this, or if you want to dig deeper, these are people who might be able to help you, or here's some spreadsheets you can download, some how-tos, just every resource we can possibly find around financial TA. But it's also raised this bigger question of, okay, even if these financial TA networks exist, do they have what they need to meet this moment? If this truly gets as bad as the 1980s farm financial crisis, my suspicion is we're probably going to need a lot more men and women in the field available to take phone calls from producers, look at financial spreadsheets, help advise them on their rights. So even after we map that financial TA network, how well resourced is that network? I want to reach out to those folks and say, what are you seeing? Are you seeing financial distress? What are producers asking for? Where are there gaps in what you're doing? And that could potentially look like some opportunity to do regranting and better resource them existing financial TA networks and make sure that producers feel empowered. That would be my biggest wish in this moment, is that a producer doesn't walk into their lender's office already feeling defeated and like they're just there to hear the news. I want folks to feel like they can ask questions and pick out certain terms and ask a lender why that term, or even just understand basic foreclosure rights. And I know when I'm saying there's implicit indictment that there's predatory lending out there, there is. Predatory lending is a very real thing. And whether a banker knows they're engaging in predatory lending or not, I think we could spend a lot of time talking about that, just in terms of what is the current culture of financing capital. But again, our big wish right now and our big think is, how do we make sure producers are as protected as possible to be advocates for themselves in this moment?
I really appreciate you talking in depth about this. I read a lot of, atomic news articles about atomic pieces here. What's happening in the soy market, what's happening in the cattle market, what's happening with land prices, what's happening with debt burden. I'm curious if you can help us understand sort of the scope of this, contributing factors and scope. What cropping systems, are there any cropping systems in particular? What regions in particular? How do you think about the potential magnitude of this?
That's what we're starting to think about, Patrick. And it's information that I don't think any of us in the field readily have available, put together in a nice, pretty package of why are we facing this moment. I think we see some interesting tidbits and headlines around, of course, you see the classic combo of tariffs, inflation, rising input costs, the average consumer, their dollar doesn't go as far at the grocery store, kind of the common factors that we see. But in terms of granularity, what crop types, what regions, what types of producers, that's information that we want to start gathering and understanding. And it goes back to what I was saying earlier about these existing TA networks. How can we already communicate with folks serving farmers and understand who's being hit the hardest, in what ways, what's actually happening on the ground. And for me personally, it's a fine balance of reading the news, but not only reading the news and trying to get our own assessment of what's actually happening. So all to say, that's information that, we're really trying to understand right now. And we know that sometimes there's media fear mongering at headlines, and we're trying to elucidate where is it just the hot media headline and where is this actually really happening. One example, I'm seeing a lot come out of Arkansas. Arkansas is an area where I'm seeing producers go to town halls and rallies, and saw a really unfortunate report with an equipment financer there who said 5 of her clients have already committed suicide. And of course, we can't necessarily tie that back to financial distress, but there's a really strong belief that that was part of their mental health situation. So we're tracking what we can in the news, but thinking more, how do we root this in data and really understand, where are the foreclosure hotspots? Where do people perhaps need help the most? And if anyone's listening to this and has that data, has that information, or also wants to start trying to make these heat maps of foreclosure crisis, we'd love to work with folks because it's a very new effort for us. And again, we never want to duplicate what's out there. We just want to be powerful partners with folks who are already doing this work.
I think of Maslow's hierarchy as you're talking about this, and just the sort of root need to meet basic life needs is, the most important thing. And for folks in financial distress, clearly that is the thing that is most important to them. And at the same time, you're talking about DF2, dignity in farming is dignity in finance, which I love that framing. Term takers versus term negotiators, trying to flip the script there. Like, to what extent do you think there's the possibility of making short-term impact and influencing some of the factors that are lower in Maslow's hierarchy in order to serve some of the goals for long-term systems change?
Patrick, that's such a good question. I think a lot of us in this space, especially folks who've been in it for a long time, we wake up every day and think, am I actually changing anything? What's my ability to actually make something different for someone? And the EQIP Bridge Loan program's been giving me a lot of hope these days because it's an opportunity to actually engage with producers and have that one-on-one conversation. And I think it's very easy in this work sometimes to slip into that more theoretical academic viewpoint when you aren't necessarily speaking to farmers and ranchers every single day. And it's a hard question to answer. How many producers would be enough producers to help? Or when do we feel like we actually did what we're supposed to do? I don't know that that's the question that I focus on a lot, because the answer, quite frankly, is it would never be enough. I don't know that we would ever feel like we did enough to change some of the economic conditions facing producers, or to change the fact that your lender has so much control over what you grow and how you grow it. So we really focus more on the day-to-day, month-to-month. How can we get the loan guarantee project funded with millions and millions in guarantee capacity, help lenders say yes more often? And again, back to the systemic pieces. That's what I think is more interesting to me, is how do we open up USDA loan guarantees so that we can shut down the program? I would love the USDA to put us out of business and take on that piece so we could go to the next aspect of the safety net that's not quite right for regenerative producers or hasn't been serving us well. So yeah, we try to think more from the systemic standpoint, and I've had to really manage expectations for myself around that being more of a generational and at times perhaps intergenerational endeavor. And for me, it's what can I contribute to that momentum, and then the next person in the next generation takes it and runs with it. Changing the culture of capital in a capitalistic society where lenders have it pretty good in terms of how well they can de-risk their loans and how land is such a great asset to have to sell in the event the borrower doesn't make their payments. I mean, it's a huge system to think about changing. So I try not to think in KPIs. I try and think more in when have we finally tipped things over enough that the system has so much momentum that change is inevitable.
Lauren, I'm curious to talk a bit more about soil health, the namesake of the podcast, as an explicit focus of your work and experience. And the question that's coming up for me, I haven't formed it fully, but when I listen to you, what I'm hearing is by changing the financial system, we will create the right infrastructure for farmers to prioritize soil health or unconventional types of production, like your example with your goats. And I've heard that echoed in like Zach Ducheneau's work with the fifth C and how he's focused on really transforming the financial piece of the puzzle here. Is there any risk, do you think, in assuming that by solving those financial pieces, soil health will increase? Or do we need to more explicitly focus on soil health and solving some of the economic barriers there, such as creating ecosystem markets? I don't know if that makes sense, but I'm curious what this brings up for you.
Yeah, so I'm hearing just how much does actual soil health really fold into how we think about systemic financial transformation?
Yes. And I guess like, do you think of it as by default a result of this work, or do we need to more consciously manage for it to be a result?
Fascinating. Yeah, a lot of thoughts. And it's funny you mentioned Zach, because I think Zach and I are very much birds of a feather in how we think about some of these things, because we both were ranchers. And this is going to really get me on my soapbox now. So apologies in advance. Thinking as a producer, if folks come to me and tell me exactly what practices I need to do and when to do them and how to do them, I don't know that I would have received that well. Unless I had explicitly gone out and sought out that information and said, I have this problem with invasive spiny pigweed and I don't know how to get rid of it. What solutions do you have for me from the regenerative movement? I think we lose sight of the fact that producers have a lot going on every single day, and they didn't just wake up yesterday and go like, what is soil health? What is regeneration? A lot of farming operations are moving at about 1,000 miles per hour. So for them to spend tons of time saying, where am I failing my organic matter score and how can I do better about that? First of all, there's a lot of time capital producers would have to allocate to that. So I share Zach's sentiment of, should we really be telling producers what they ought to be doing, or should we free up some of their cash flow and see what they think would be best for their operations in that moment? And I have a lot of respect for the autonomy of a producer, and that's why some of the current lending patterns, quite frankly, upset me in terms of you're not going to get a loan unless you grow something the way we tell you to grow it, or unless you grow something that qualifies for a subsidy payment. That, quite frankly, like makes me bristle, because who is that lender, or who is that agronomist, or who is that academic to tell that producer that that's the best thing for their operation? Especially when we're talking about folks who've been farming the same land for multiple generations and know that land better than any economist could ever hope to know it. Do I think that financial systemic transformation is by default going to increase soil organic matter? I don't know. I don't think we can say yes or no explicitly. I think in some cases, yes, folks are going to make decisions in their operation that ultimately lead to better soil health, even if that wasn't the reason they made those decisions. Maybe they tried a different species or a different cover crop or a different market that just so happened to also improve soil organic matter. I don't think I take a very myopic approach to it. I don't think that one particular measurement is going to be the be all end all of determining progress. And I know for the quantitative folks, that can be really hard to swallow. But for me, there's a lot of qualitative assessment for what does regeneration mean on one farm. And what was regenerative for me in the Ozarks was not necessarily regenerative for a beef producer in Idaho. It's a completely different space. So really, for me, it comes back to, why shouldn't we let producers decide? And why shouldn't we at least let them have the first say in what they do with that extra capital? Maybe some of them would probably invest in health insurance before they'd invest in things like cover crops or interseeding. And who are we to say, no, you shouldn't get insurance. You should adopt some kind of soil health practice. I think the state of a lot of farmers economically is more dire than some folks in regeneration realize, in that there's some basic human rights and basic baselines of living that producers go without. And maybe we should fold some consideration of those things into the equation before we start focusing on carbon and soil health and all that, and just see, if producers actually are healthy and feel taken care of and they have a little extra cash, then it'd be interesting to see where they put it. I know that was a very long-winded answer. It's such a complex question of, what are the right levers, as people say, to actually change farming across America. I see it less black and white. I think there's always going to be feedlots for the next couple generations. And I think there's always going to be commodity crops. For us to completely transform the entire American food system in one generation would require so much buy-in and capital and consensus. I think it's going to be a much longer timeline than that.
Lauren, I so appreciate your perspective and the work that you do. Really, really vital. And both in terms of long-term systems change and clearly in terms of short-term, helping to solve short-term challenges. I saw recently that you had posted on LinkedIn about finance serving farmers as opposed to farmers serving finance. And that seems to be like a good umbrella description of the work that you do. I'm wondering if you have a last thought or comment, something that you feel is most important to leave our listeners with.
Thank you for the kind words, Patrick. I appreciate it. Just so thrilled for this opportunity to speak about what we're doing. The tagline I'm leaving folks with lately is a bit depressing, but I think a lot of us in the space, myself included, could never hurt from a bit of a slap in the face and some perspective on when we're asking producers to adopt regenerative agriculture, what are we actually asking of them, not just economically, but from a social standpoint. A lot of producers who deviate from the conventional norm, they get ostracized from their communities. So I think it never hurts for us to all sit back and say, what are we actually asking of these producers when we're saying you need to transition to regenerative agriculture? And the tagline that sticks with me is, we can't ask the people who are regenerating the land to risk losing everything in the process. What are we really asking of them? Where can we step in and help shoulder that risk? That's what we're trying to do with the Guarantee Program. How do we bring philanthropic capital to the table to better apportion risk in the same way that the Federal Farm Safety Net apportions risk for conventional agriculture? And how do we make sure that what we're asking is not only reasonable, but there's a real value proposition for those producers on the other side of it?
Yeah, really wonderful. I love that note to finish on. And it's a good, sober reminder about our land stewards.
Yes.
Yeah. Thank you so much, Lauren, for your perspective and for your time today.
Thank you both so much. This was a pleasure.
Thanks for listening to this episode of The Business of Soil Health. Our goal is to explore how new financial tools may or may not support producers' stewardship of their soil. We love hearing from listeners, so don't hesitate to reach out with any suggestions or guests you'd like for us to feature. And don't forget to subscribe or leave a review on your favorite podcast platform.